Nifty's hanging on to that 19,800 mark.
Absolutely evenly balanced when it comes to the benchmark indices.
We are around that 19,811 mark.
If you're looking for a range, the high and the low of the day actually will be the broad range because, we went to around 19,844 and from there we did see some bit of selling. So I think we should get that number up for you on the screen. And on the downside, we're into 19,773 odds.
Nifty is just shy of that 19,800. We spent a greater part of the trading session well above 19,800, but in the last 1 hour, we did see the bit of softness, and it looks like the close could be below that key level.
Hello and welcome to Markets Today. I'm Ekta Batra. Here are the top market headlines for this evening. The Sensex and the Nifty end with marginal losses after a range-bound session. IT stocks dragged the markets after TCS reports cautious commentary. After TCS, TechM falls the most. Nifty bank and mid-caps outperform in a subdued market. Infosys beats estimates in the second quarter with a revenue growth of more than 2%. The company lowers the top end of its full-year revenue growth outlook from 3.5% to 2.5%. IT stocks sulk in trade after TCS reported a mixed bag yesterday. State-owned miners like GMDC and MOIL get a fillip after the cabinet clears royalty fees for mining of 3 critical and strategic minerals. GMDC hits a record high while MOIL surges to a 52-week high. Glenmark Pharma's arm, Ichnos Sciences, inks a drug license deal with Astra Therapeutics that will net it $320 million in upfront development and milestone payments besides low double-digit royalty. The stock perks up. Zomato surges as Kotak Institutional Equities expects an improvement in the second quarter. Sula Vineyards gains on reporting 11% increase in net revenue on a yearly basis. Zaggle prepaid reacts to its first results post-listing. Grasim perks up on fundraise plans. All right, well, on to all of the action from the Wall Street. Markets declined marginally after a range-bound session. Benchmark indices saw red today, slipping marginally, while both the Bank Nifty as well as mid-caps showed resilience. IT stocks also dragged the market lower after TCS's second quarter results. Surbhi Upadhyay joins in with a wrap.
Well, it was a day of consolidation. Fair amount of caution, you'd have to say, was playing out on the street over here, perhaps consolidating the gains that we made earlier in the week. So if we talk about it, it was basically IT numbers and the delivery from TCS in the form of the numbers themselves and the commentary that only added to the certain sense of unease or uncertainty that markets have been grappling with. There's geopolitics, there's high interest rates, and now you have these IT earnings. In fact, the Nifty IT was the worst performing index today, and all the large cap stocks, TCS, Infosys, LTI, Mindtree, Wipro, you name it, HCL Tech, a lot of them come out with numbers in the next 48 hours. They were all down and out. Other Nifty losers included some hospital and pharma names, Apollo Hospitals, Cipla, with no clarity on what's happening with the stake sale of the promoter family, and Bharti Airtel had a weak session as well. Then let's talk about banks. If the bulls were hoping for support from this corner, well, it wasn't really coming today. Very range-bound day for the Bank Nifty, a range of about 150, 160 points. That's about it. And towards the end, the Bank Nifty ended at the low point of that range. However, if we talk about gainers, one sector really stood out, and that was the PSU space. Massive rally in a lot of PSU stocks, starting with some of the mineral or mining names which are owned by the government of India. And why is that? Because there is a new royalty policy in place that is seen as slightly favorable by the street when it comes to mining of rare earths or certain strategic minerals. So stocks like GMDC and MDC, a lot of them were flying around. MOIL, a lot of them were up between 4, 5, 6%. MMTC was up almost 19% as we closed out. The PSU rally actually rubbed off on other names as well, the larger names, Coal India, NTPC, Power Grid, largely speaking. So a very solid day for PSUs once again. Should mention Maruti here, 1.5% up. The market was a little excited about exports of Jimny. The company is saying they'll be exporting this car to a lot of the other emerging markets in Latin America and Middle East. So that worked quite well. A word on mid-caps before I sign out. Very quiet day. There was some consolidation there. The mid-cap index wasn't really, lit up, so to speak, but there were more advancing stocks than declining stocks. And some of the names include Nippon Life, CAMS, and Aster DM. So as we round up the day and we get to the end of the week, it's going to be all about the inflation print here in India and what the US CPI print does. That will determine how Friday plays out.
All right, on to some market opinion. Atul Suri, CEO of Marathon Trends, PMS, says despite the ongoing Israel-Hamas war and other global headwinds, the market is seeing an upward trend.
The market's actually saying that it wants to go higher. There are four big global macro issues, right? You've got Ukraine war, which was supposed to last for 3 weeks, and I think we'll get into year 3. You've got now a new thing in Gaza happening with Israel. A lot of variables can open up with Iran, Lebanon, etc., and the world knows about it. In spite of all that, you'll realize that what is the market doing? The market is clearly sort of saying that in spite of all the bad news, it's tending to wanting to go up. And I think that's very important because the market has a mind of its own. And I think that there's a lot of pessimism. I think the market is very oversold. We've had a correction globally, 6 to 8% among the larger indices. I do think that in spite of what happened in Gaza and Israel, the markets are trending higher.
All right, on to the second headline now. Infosys has reported an overall beat in the second quarter. The tech major has reported a revenue growth of more than 2%. The company has lowered the top end of its full-year revenue growth outlook from 3.5% to 2.5%. Rima is here with the details.
Thank you very much for that. A very strong Q2 for Infosys, higher than estimates, yet the company lowers its guidance for the full year. Very perplexing. Coming to the Q2 numbers, the company has reported a constant currency revenue growth of 2.3%, ahead of estimates and much higher than what its peer TCS reported, which was basically a flat quarter. In that context, Infosys has clocked in a good performance on the revenue front. Margins expand by 40 basis points to 21.2%. Again, slightly better than street expectation. The key highlight are the deal wins. Deal wins for the company at $7.7 billion, highest ever, and this compares with a 4-quarter average of $2.6 billion. 46 or 48% of these new deal wins are new. They're not renewal deals, they're net new deals. So it's a very large and a very strong number on the deal front. Yet, the company has lowered its guidance. They're now saying growth in FY24 is going to be just 1 to 2.5%. Earlier, it was a 1 to 3.5% guidance for the year. So the upper end of the guidance has been brought down by 100 basis points. This implies that the company is likely to degrow in the second half of the year despite very strong deal wins. In fact, this is the second consecutive quarter where Infosys has in a way moderated its guidance. They started FY24 with an expectation of 4 to 7%. They brought it down to 1 to 3.5%. And now again, the upper end of the guidance has been brought lower. Headcount has declined by more than 7,500 employees on a sequential basis. They have embarked on a cost optimization margin improvement plan. So they're holding on to their FY24 margin guidance of 20 to 22%. So strong Q2, but the street will be disappointed by the cut at the upper end of their revenue guidance for the year.
We had a strong quarter in Q2. We had growth of 2.3% quarter on quarter and 2.5% year on year in constant currency. We see that with our large deal wins in the past 2 quarters, we are winning market share in the area of cost and efficiency. As the economic environment changed, we pivoted from delivering transformation projects to also delivering productivity benefits and cost savings at scale. These large and mega deal wins help us build a strong foundation for our future.
All right, and staying with earnings, TCS shares dropped in early trade after the company reported a mixed bag in the second quarter. The IT giant's dollar revenue growth shrank for the first time in more than 3 years. However, profit and margins beat street expectations. In an interview with CNBC-TV18, the company's management said that top-line visibility is not good, but it is best to focus on margins. TCS also saw a headcount reduction of over 6,300 this quarter. Milind Lakkad, who's the global HR head, said they expected similar numbers on headcount reduction front in the future.
Our customers are taking actions to handle what they see is a potential situation, which is resulting in, as I said, projects that are having immediate ROI getting more attention and where they don't see the ROI getting less attention. We have taken steps this quarter. We are assuming some of them will yield results in the subsequent quarter also. So, and all our teams are geared up, particularly when you don't have good visibility on the top line. I think it's natural to focus on the bottom line, so that focus will continue.
We are, in making all the investment which we made in the past is now getting, eventually we're getting fruits out of it. And as a result, we are, attrition also is coming down. and as a result, we're recalibrating our hiring. So our hiring numbers are going to be less compared to our attrition. And as a result, I see, the number will be, lower significantly. If it is, a low positive or a negative number is very difficult to say.
All right, on to the third headline today. Mining companies like NMDC, GMDC and MOIL rallied between 4 to 10%. The stock surged after the cabinet approved the royalty rates for mining of lithium, niobium and rare earth elements. Nigel D'Souza standing by with the details on this.
Well, let's explain why some of these government-owned mining stocks are buzzing today. Well, the cabinet has approved royalty rates for the mining of 3 critical and strategic minerals. That's lithium, niobium as well as rare earth elements. The royalty rates have been fixed at around 1 to around 3% of the selling price. And the street cheers that these royalty rates are, unless they are specifically mentioned, these minerals would have been subject to a 12% rate of royalty of the average selling price. Now, the cabinet has fixed the rates lower as these minerals have been assumed utmost importance in India's economic advancement and national security. Basically, these critical minerals are important as we move towards carbon neutrality goals. This also encourages indigenous mining and will lead to reduction in imports and setting up of related industries as well as infrastructure projects. Well, this in turn will enhance employment generation within the mining sector itself. So the government-owned mining companies, well, they're flying away on the news, but we need to keep in mind that this is just a stepping stone. And currently the government is still exploring on any deposits available for strategic minerals. Well, GMDC has been talking up the opportunity, but we need to see some fixed announcements on the rare earth opportunity. There's a long way to go from here on. There's going to be exploration, auctioning, getting environment clearances, setting up infrastructure, and lastly, commissioning. The street believes production could be a few years away, but for the time being, the street is cheering that the royalty rates, whenever the good news comes, will be relatively lower in comparison to other minerals. Back to you.
All right, time for a short break. Thanks, Nigel, for that. We'll be back with all of the other top stories that we're tracking this evening. Welcome back. You're still tuned into Markets Today on CNBC-TV18. Well, the fourth headline today, Glenmark Pharma gained over 1.5% after its R&D arm, Ignore Sciences, entered into a licensing agreement with Astria Therapeutics. Now, this is an important deal for Glenmark because it will, in fact, result in an upfront payment of around $320 million and low double-digit royalties going forward as well. Now, this particular portfolio, which they have out-licensed, OX40, basically is used for inflammatory as well as immune diseases. This is positive as the company is going to be sticking to its guidance, one of debt reduction, because they have, remember, sold 75% stake in their API business to Nirma for over 5,600 odd crores. And one of the other parameters in terms of FY24 guidance was one out-licensing deal. So positive news which has come in for Glenmark Pharma. Ignos is a subsidiary of the company. Moving on, the fifth headline today, Zomato surged nearly 1% after a bullish note from Kotak Institutional Equities. The brokerage firm has upgraded the stock to a buy rating. Mangnam is here with the details on this.
Zomato was higher in today's trading session on account of a bullish note coming in from Kotak. In fact, a lot of these new age companies have been doing well for the last few trading sessions. Zomato's reason today, or rather Kotak's reason for liking Zomato, is that they believe that the growth rate in their gross merchandise value has actually bottomed out. They've increased their face value, or rather fair value, for the stock from 110 odd rupees to 125 rupees as well. And they believe the 14% GMV that the company posted in the first quarter is likely to, improve a lot more as soon as the second quarter as well. And going forward, they believe that it could grow anywhere around 18 odd percent. So that's what they've set their expectations for the next 3 fiscal years. Not just that, if the gross merchandise value grows at 18%, the revenues grow anywhere between 10 to 14 odd percent, The EBITDA grows between 10 to 20% as well. The company has been surprising positively on profitability over the last few quarters, and the near-term big events like World Cup, etc., would be extremely good for them as well. And they've been slowly gaining market share in what is otherwise a duopoly market with Swiggy as well. So all these factors should do well for Zomato, is Kotak's thesis.
All right, moving on, Sula Vineyards rallied over 2.5% on the back of its second quarter business update. 74% of the revenue came from its elite and premium wines. Surbhi Sudaria is here with the details.
Thanks so much for that. So the Q2 business update by Sula is pretty strong. Their net revenues for the quarter was up 11%, came in at 129 crores. Now their own brands revenue, that was up 14%, came in at 116 crores versus 102 crores same time last year. And within their own brands, elite and the premium wines, which is 74% of their revenue, that was up 18% on a year-on-year basis. Apart from that, the smaller part of their business, which is wine tourism, there the revenues were up 26%, came in at 12 odd crores versus nearly 9.5 crores same time last year. And the wine tastings that they did this quarter was over 43% year-on-year growth, came in at over nearly 50,000 wine tastings this quarter itself. So premiumization trend and wine tourism, both of them are doing well for Sula.
All right, Surbhi, thanks very much for that. Moving on, Zaggle Prepaid Ocean Services reported a healthy jump of 33% in revenue in the second quarter, but the financial costs surged and margins contracted. The promoter, MD and CEO of the company says that the gross margin of the company will stabilize over time. Listen in.
In terms of the margin mix, of course, with our Propel Points, which is our rewards platform, our take rates there are higher. But the way India's operates, when a corporate gives points to an employee, we recognize the entire points that are being redeemed. These are vouchers. These are points that are redeemed for vouchers. We recognize the entire 10,000 rupees. Let's say 10,000 rupees of points are being redeemed. We recognize the entire 10,000 rupees as our revenue. And let's say the cost of the voucher to us was 9,000 rupees. We recognize 9,000 rupees as our direct cost. So naturally, this business, while the take rates are significantly higher, our gross margins get impacted. But we expect these margins to stabilize over time.
All right, that's Zaggle, but on to some more stock-specific news. Grasim Industries gained 1% after the company indicated that it will consider fundraise in a board meet on the 16th of October. Investors hope the funds will be used for capex or debt reduction. Nigel is here with the details.
Well, that's right. Grasim is in focus because they have announced that on October 16th, they're going to be considering raising funds. And it could be a QIP, it could be a preference issue, as well as a rights issue. So we'll have to wait by in terms of, what are they going to do with regard to the instrument. But what can they do with these funds that they're looking to raise? One factor could be they're looking to fund their capex. The second factor could be that they're looking to deleverage their balance sheet. So let's run you through a couple of numbers. The last reported net debt number is close to around 3,500 crores. On a quarter-to-quarter basis, that's from Q4 FY23 to Q1 FY24, it close to have doubled. And also in terms of the capex plan, well, they spent close to around 1,400 crores, but they've guided that they'll spend more than 5,700 crores in this year. So maybe one of these two avenues is where they're going to use this money to whenever they go ahead with this, fundraise plan. The street, though, will be very, very cautious, and they'll be hoping none of this money goes towards Vodafone Idea. But the management in the past has clarified that none of the money from Grasim will be routed to Vodafone Idea. So the stock was in focus today.
Okay, all right, Nigel, thanks very much for that. And before we wrap, let's shift our focus to the NBFC sector. Analysts are expecting cost of funds to peak and margin guidance to improve in the coming quarters. Abhishek Kothari is standing by with a wrap. Abhishek, over to you.
Well, for NBFC sector, it's going to be a strong quarter in terms of their AUM growth or loan growth as well as earnings momentum. While banking sector will face rising cost of funds in Q2 FY24 and for next couple of quarters, NBFCs will see their cost of funds peak out in Q2 FY24 or at the max in Q3 FY24 for some of them. Hence, one can expect guidance on net interest margin to be better or improve from the lenders for the coming quarters. Momentum in disbursals to remain strong, which will actually aid in the loan growth also to be on the healthier side or on the stronger side for many players. Consumption-based demand has been strong as seen in the pro forma business update of Bajaj Finance. So let's take a look segment-wise what to expect from each of the segment in NBFCs. For housing finance companies, disbursals and AUM, that is asset under management or loan growth, will be be on the healthier side. Net interest margin is expected to remain steady for top players like Canfin Homes, PNB Housing, etc. Net interest margin can moderate for small ticket size loan players like Repco, Aavas and Home First Finance. For commercial vehicle financiers, they will see loan growth to be on the healthier side, except for Shriram Finance and Sundaram Finance. Shriram Finance typically has seen growth in second quarter to be slightly on the weaker side when compared to other quarters, so seasonal in nature. Cholamandalam's AUM growth rate can be in line with their Q1 FY24 performance, that is around the 40% YOY growth or year-on-year growth. For microfinance sector, this will be the segment of focus for investors. Now, strong disbursals will aid in loan growth for many players. Don't expect any asset quality headwinds except for the one expected in Fusion MFI. Some of the stocks have already rallied or seen valuation rise due to the strong earnings expected in Q2 FY24, which has been discounted in the stock price. So gold financiers, IIFL Finance strong show in terms of growth will continue even in this quarter like it did in the previous quarter, while competition from banks will continue for players like Muthoot Finance and Manappuram. Hence, one can see moderation in growth for Muthoot Finance and weakest gold loan growth in case of Manappuram. So the expectation on net interest margin will be on the steadier side for all the gold financiers. Consumer finance loan growth will be healthy due to better demand and improved macro situation. There can be slight decline in net interest margin owing to rise in cost of funds. However, no asset quality woes are expected. Some of the key lenders estimate from Kotak Securities are for Bajaj Finance, they estimate NII growth of close to 29% YOY and about 6.2% quarter-on-quarter, while PAT is expected to grow at 29% YOY and about 4.5% quarter-on-quarter. For Shriram Finance, NII growth is expected to be at 17.3% YOY and about 3.7% quarter-on-quarter, while PAT is expected to grow at 24.5% YOY and about 5.5% quarter-on-quarter. For Muthoot Finance, the NII growth is expected to be at 23.6% YOY and about 2.6% quarter-on-quarter, while PAT is estimated to grow at 16.4% YOY and about 3.5% quarter-on-quarter. For LIC Housing Finance, Kotak Securities estimates NII growth of 74% YOY and a decline of 8.4% quarter-on-quarter, while PAT is estimated to grow at 282% YOY and a decline of 11.7% quarter-on-quarter. Back to you.
Okay, all right, Abhishek. Thanks very much for that. With that, it's a wrap on this edition of Markets Today. Thanks very much for watching.